So succession planning, you guys are all way too young to worry about retirement, but I'm going to use but. This is a good time to start thinking about it. And it's the only time I'm going to use that word, promise. This is a great time to, and why is this a great time to be thinking about retirement? It is the best way to really focus on what your goal is for your company. And for all of the work that we do, improving your business, making it more efficient, making it more profitable, the question is, why are you doing that? Why are you trying to make your business better? What is the goal for you for your business? And I had this conversation. I was at Hort East in Halifax last week. I had this exact conversation with a gentleman who is closer to retirement age than many of us. And he said he doesn't worry about his exit strategy because he's going to be dead when he leaves his job. And I'm like, that's horrible. But so unless you want to die at the end of a shovel, I suggest having some strategy, because sooner or later we're going to want to do something in our personal life, a new career, for example, and these are things that are more realistic goals to strive for. So, but how do you get there? And what I'm going to talk about is, even if your exit strategy is 10 or 20 years in the future, it's still important to do it now, because a good succession plan is really a profit-driven turnkey system. So what George is talking about doing, making your business profitable, makes it more valuable, makes it more desirable if you were going to sell it to somebody. It makes it more efficient, more attractive. It gives an opportunity, if you have good staff working in your company, it gives you an opportunity perhaps for your staff to take over the business because you've built a great team. These are all things that are connected. So it's not about working on efficiency. It's not about creating growth. It's about doing it for a purpose. And a succession plan just defines what that end goal is. And to what George presented, he talked about making you more efficient. So you want to talk about, what is my business worth? The sooner you make your business profitable, the more your business will be worth in the future. That seems obvious, but why do so many people resist looking at themselves critically and making those choices? Some of those decisions might be hard. It might be that you have to admit that you're not great at everything in your company. Those are hard questions to answer sometimes, but if you are serious about running a business, you should be looking at your business like a buyer. Would you buy your business is a good question to ask. And if it was more profitable, it would be more desirable. If you make your business more profitable, those earnings, annual profit, gets either built into your personal balance sheet or your business balance sheet. And you'll accumulate more equipment, more property, greater market share. All of these things you're going to add to your balance sheet. So if you can start sooner by improving your efficiency and bottom line, you will have way more money. So I did a little graph in Excel. What's the difference in a business, a $200,000 a year business that has 15% growth in sales and 2.5%, 5%, or 10% profit? And if you have a $200,000 business in 25 years, I hit $6 million. If you're running a 10% profit and you're growing your business a little bit every year, there's a lot of money potentially there. Now that profit might be put into assets, like you might have a fleet. You might have $1 million worth of equipment, $1 million worth of vehicles, a $3 million property. You might have some investments, a nest egg somewhere to weather some bad times. But that's a profitable business. That is a business that is worth a lot of money because you've created profitable, repeatable systems. So that's why I want to think about, what George talked about should be part of your exit strategy. The other thing to worry about is how quickly can you exit your business if something happens. Your spouse relocates and you want to shut down and move your business. That's not that easy to do, especially if your business is not organized or profitable. And all that work you put into it, you might not be able to get all that effort back out of your business. Are you the only thing holding your company together? So again, this goes back to who is responsible for what. If you're in that top left box of George's diagram, if you're the operator and anything happens, you hurt your back. I mean, I know that was one of the motivators for George and I to grow our business, and we were worried that we might not be able to do it physically for our whole lives. So we said, what if we were to build the company big enough so that we weren't needed on the job site? And that helped us understand what our strengths were, what we could focus on. And we ended up extending that obviously to our roles in the company, and which allowed George to ultimately exit the operations at Oriel. And this was one of the, I think this is one of the questions in your worksheet. Is it? I think it is. Is it the next one? I don't. Yeah. So the questions are you ready to let go? And this is just an exercise. I'm not going to ask you to share this, but the key is that you have to understand sort of where you are mentally in your business. Are you a controller or are you a conductor? That's really the difference. And if you're an operator, if you're in that top left box on George's diagram, you're going to be in there tinkering. You're going to be telling people what to do. And that's going to make it impossible for your business to grow, for the people in your company to grow. It's going to be impossible for you to exit that role at some point. So you have to think about that honestly, about what you're doing in your business and why you're doing it. So think about where you are maybe on this list, because all of these things can be an obstacle for your staff to grow into leadership positions, and an obstacle for you to be able to step away and ultimately exit the business. And the sooner you do this, the sooner you recognize these, and the sooner you step back and allow your company to function without you involved in everything, the sooner you can start moving that profit graph as well. Does anyone have any questions about this? It seems obvious. Like, a lot of this stuff seems really obvious that we're going to be sharing today, but it's really helpful to take a minute to think about where you are at and to be honest with yourself about what obstacles you might be putting in your own way. So that's, which ones have you already eliminated? So a lot of these things you might not be guilty of. And so check off the ones that you know for sure you're not. And George?
One question that you can ask would be, how many of you identify yourselves as the business owner? Like, that's my identity. I think you can read that question out loud.
Yeah. How many of you are the business owner? Okay. How many of you are the business operator? A lot of the same people, okay? And the difference is, as you step back away from the business and you move through those boxes to CEO, there's one more box George had on there, chairman, and chairman is more like an investor. And that's sort of the final step in that process where you're not managing the day-to-day. You are able to relinquish the sales. And chairman is really an advisor to the operations of the company. And at that point, you have freedom. And that's where George and I are with Oriole Landscaping, where we are at that point now where we can be here or doing other things with Knowledge Tree Consulting, where Oriole is capable of running independently from us. So we're at the point where we could sell Oriole. George offered to buy your businesses. I'm also offering to sell Oriole if you're interested. Make an offer. The point is that Oriole can run without us, which makes it easier to sell because I can sell a functioning entity. It also means that George and I don't have to sell it because we're not tied to the business anymore. So that is the ultimate level of freedom as a business owner. So we're more of an investor in Oriole now than we were operators or business owners. So I think that's maybe the distinction you were hoping to share. So this is George's graph again. I stole it from your presentation. Thank you for preparing it, George. So the point is that we wanted to, sorry for those in the back, the last one is chairman. And chairman, who is on the team? When will it happen? How will this happen? So really the ultimate goal is to be the least important person in your business. And that was something George articulated, I think, 20 years ago. Your uncle shared some advice, and it was really like a wake-up call. It's like, wouldn't that be fantastic if we were the least important people in our business? And that's really just a concept that we repeated ever since we made it public. Our staff knew that our goal was to get out of the way. So it freed our staff to make choices, to make decisions. We would empower our team to make decisions, give them those opportunities to learn. We would guide them in that process. But ultimately, they knew and we knew the ultimate goal was for them to be good at that role so that we could then remove ourselves from that. So how do you maximize the value in your business? So that graph with the money just piling and piling on, how do you maximize, how do you get to that point where you maximize the value in your business? So I'm going to come back to the balance sheet as well. So this balance sheet that George talked about, he already shared some of the points on the balance sheet. But some of the things that are hard to, well, for those in the back, you can't read it at all, but some of the things that are hard to define in terms of value that doesn't show up easily on the balance sheet, and George touched on goodwill. There's a lot of things that are soft value in your business that may not show up on here. So there are things like the people, the managers in your business. And so the team that George and I built are the reason that we can step away. They're also huge value for a potential purchaser. So a lot of these big companies, you know, if you hear about acquisitions, it happens a lot in the States. It's happening a little bit in Canada, where massive landscape companies are buying other large landscape companies. And I've had the privilege of speaking with some of these owners of these massive companies, hundreds of millions of dollars in sales and hundreds of millions of euros in Europe. And the constant quality that they're looking for when they're buying a company is the management team. They're looking for a team that can run a market. That's it. They can bring their systems, they can bring their equity, but they're looking for the management team. That's the highest value for a potential purchaser. They want, you know, recurring commercial contracts. That's high value, but it's the management team that sets the price. If that management team can run that company without the owner tinkering, then you're going to have a company that is very easy to sell. And that doesn't show up on your balance sheet, you know, the value of a good management team. The good management team will show up in the profit, but it'll be sort of hidden. You have to dig for it. It'll show up in the customer satisfaction. Again, customer satisfaction doesn't show up on the balance sheet. You don't have surveys on your balance sheet. So these are all things that soft values and soft equity that won't show up here. It's just called goodwill, right? Intangibles. Who here has does customer surveys? Okay, that's something I'm going to say would benefit all of us. So knowing your customer's experience, again, it's okay for them to be honest. You're going to hear some things you might not want to hear. It's not a good reason to avoid the question. Find out from your customers what they like about your company. It'll be a lot easier for you to sell to the next customer if you know what your strengths are. It'll be a lot easier for you to sell to the next customer if you know what your weaknesses are, where your shortcomings are. You can fix those problems. So George is writing a book, 911. I'm going to write a book, Bad to Great. And in my book, it's going to be about fixing those bad things. If you're doing a couple of things badly in your business, in your product, in your sales process, 9 times out of 10, if you just fix those few bad things, you will have a great sales and great operations. Yeah.
Would you ever do that with not just your customers, but maybe your subcontractors as well?
Yeah. I mean, we have some great subcontractors here in the room as well, and it's knowing their experience. They're usually more forthcoming with feedback, right? We've had a great relationship with Marcello there at Elite Concrete for 20 years, and so I know how he feels, and that's very helpful, right? And it's great to have a professional relationship like that. But surveys from your staff as well. So George, yeah, and eating some of your mistakes early on in your business will build that trust with your clients, and I can attest to the fact that Elite hasn't had to rip anything out since then. So they do excellent work, and that excellent product sells itself. So they're very busy. So if you do want to use Elite, you have to book them way in advance. So, yeah.
On that customer survey at the end of projects, what are some questions that so it's obviously what did you like about the process with working with your company, and maybe it's like what are things that could have been better?
Yeah. You want, yeah. Essentially, you want to know about the people that worked on the job. You want to know about the sales process. You want to know about the accounting process, like contracts and accounting and invoicing. Like that experience is what they'll remember.
Very specific.
Yeah. You want to know about.
What would you change? What drove you nuts? And what did you love?
Yeah. So you want a rating. Yeah. So the contract, sales, invoicing, that experience is with your client manager. You've got the on-site work. You want to know. And it could be an open-ended question, like George said, what did you love or what did you hate? And so maybe 3 or 4 questions, and you positive or negative. It's all very valuable. And to get customer surveys back, you might want to say, for every survey we get back, we give $100 to Sick Kids Hospital. And so now they're doing something charitable by filling out a survey, and they get to be heard by the company that they just hired. The fact that you ask the question increases the level of trust with your customer. Just asking the questions.
I guess you could dial in the question. It's just a matter of starting that process and then dialing it in.
Yeah, you're gonna get feedback from clients, and you're gonna maybe change the questions for subsequent surveys. Absolutely. So on the balance sheet, customer survey or customer satisfaction doesn't show up on the balance sheet. But if you have that information, you will be better at delivering your product. You will be more profitable. Those customer surveys are data that if you ever did want to sell your company or merge with another company or give it to your employees, that data is worth huge money also. So all of this stuff, you're going to make more money running your company, and you're going to make more money selling your company. 10 years in the future, 20 years in the future, whenever, doesn't matter. But doing these things early, all the stuff that George presented, building your balance sheet, the sooner you do it, the more successful you'll be. So why are you in business? Who here is in business for a charitable purpose. They do it only to give to their customers, whether they make money or not. I've done it. Some of my customers got basically my work for free. I know it's happened and it hurts, but that's not why I'm in business. So that's not my goal. My goal is to give an excellent product that people are willing to pay for, that will afford me and my staff a career. And George talked about, staff. We've had staff that have been with us for 10, 20, 30 years. I think our longest serving employee is at 31 years now, or 32 years. So that's a great objective in your company, is to build this positive experience. And you're building goodwill. So again, it's something, a lot of people have goodwill on their when they show their balance sheet, and it's just some made up number. And typically your idea of what your business's goodwill is different than what a purchaser's idea of goodwill is. And the difference is data. So if you have something to back up why your business has that level of goodwill, you're going to be able to stand behind those numbers. And that puts me to this question, which is going to be on your in your workbook also. And I don't expect you to know these now. Most business owners, they do understand about profit. They do understand whether they're making money or not making money. But some of these very specific questions, you're going to have to look at your reports. You might have this as of last fiscal year. A lot of this stuff is hard to know mid-year. But these are the kinds of things that, you could use as benchmarks, even if you're looking at them annually on your annual report, or maybe every 6 months. But knowing what these numbers are will just help put your head in the frame of mind that business valuators would do. So if your goal is to make money, if your goal is to have something that you can sell or give to your kids or sell to your staff, then you're going to want to know these numbers. And you're going to want to know that this year is better than last year, and the choices I'm making are going to improve these numbers for next year. That's as simple as it is. Just think about, how can I get these numbers in the next 12 months? How can I make these better for my company, which will be more money in my pocket, more money in equity for the balance sheet, for sales. Everything else really is just noise. So EBITDA, you might hear that sometimes. EBITDA is earnings before interest, taxes, depreciation, and amortization. So a lot of companies will use this. If you buy stocks in the stock market, they say, company HLF is a health and lifestyle company. They're trading at 2.9 times earnings, and Tesla is 268 times earnings. So you talked about a company with no marketing. So this is an interesting story. This is at 2.9 times earnings. That company has very low trust in the stock market. So the reason it's so low is because people don't trust that it's going to return earnings in the future. So the fact that they made, $100 last year, people are saying, I'd only pay $290 for that stock, even though it's earning $100 in profit. That's a crazy return on investment. People don't believe it's going to come in the future, so they're giving a very low multiple on it. It's high risk. Tesla, on the other hand, you make $100 in Tesla profit, and people are willing to pay $26,000 $26,000 for the stock. That's a terrible return on your investment. So I'm not going to pay $26,000 to earn $100. But what that says is they believe that in the future, Tesla is going to be way more profitable. It's going to be 100 times more profitable than it is today. So I'm going to buy for $26,000, and it'll make me $1,000 next year, or $10,000 in a few years. That's what people are projecting with that stock valuation. So that is, all of that stuff is intangible also. We don't use that when we're buying companies in landscaping, because there isn't that wild variation. There are some really low multiples when you're buying a landscape company, I have low trust. If you guys showed me all your books, I would say, what is the likelihood of that happening next year? Who knows? Most years it's a crapshoot, right? We don't know about the weather. We don't know about the customers coming in. We don't know about the economy. There's so many external forces acting on all of our business. I've low confidence that last year's results are repeatable without a system, without recurring revenue. So we don't use EBITDA a lot. Sales multiples, so that we might use in lieu of profit. So sales multiple, let's say the company does $1 million in sales. I might say that company is worth $200,000. So your sales multiple is 0.2 times sales. And I might use that, and I might use sales multiples because the company is not profitable. You might have a company doing $1 million in sales and you made zero profit. You paid your management team, you paid all your cost of goods sold, and you have $0 in profit left over. There may still be value in your business. Those $1 million in sales, if I'm able to add those to my company, plug them into my system, I can reduce the cost of running that because I can share office resources, and I can put it in my system, and I can make $1 million in sales profitable by plugging it into my system. So you might still be able to sell a company that is making zero profit. It's going to be a lot harder, and you're going to have to hopefully have at least a guarantee that it's recurring revenue. But we can use sales multiples occasionally when you're not profitable. And again, it's generally low. And in landscaping, sales multiples, again, unless you're doing commercial work where you have multi-year contracts pre-signed, it's very hard to guarantee that there's going to be revenue next year just because you had revenue last year. Book value, that's the easiest one, right? You own equipment or you own a piece of property. You can take it to auction. That's book value. And that is at least a baseline. So a lot of landscape companies, especially nurseries with 100 acres of farmland, those companies, most of their business equity is the land. So if you're struggling as a business owner, if you don't want to worry about EBITDA and sales multiples and all that stuff, put your retained earnings, that $6 million, that because you made a profitable business, buy land, build a company on a piece of land that you own, and all you have to do at the end of the year is sell the land, and you could make all that money back, right? So that's another way if you have a long-term strategy and you have a profitable company. HBC, Hudson's Bay Company, right now they're auctioning off all their stuff, and investors are going to get about 10 cents on the dollar, I think. But that's still pretty good. The stock is worth $0, but some of the bondholders are going to get their money out. But they were a huge real estate company was really all they were at the end of the day. And management team, I touched on this a little bit before. Management team, that's worth big money. So how much do you pay for a management team? If you were going to go to a headhunter to get a manager that could run your operations, run a sales department, if you wanted to get a manager to run your snow division, how much would that cost to buy that person through a headhunting agency? You pay $10,000 to $20,000 per person to get a good employee for a role. And we've done that in the past when we were struggling to find the right candidate. We used a headhunting agency, and it worked. We have a great member of our team who's been with us now for, I don't even know how long he's been with us, 10 years maybe. Best money we ever spent. And when we bought a company recently to do maintenance, their team, their crew leaders and managers, top shelf. They won provincial and national awards in their maintenance department. They were worth big money. For me to try and hire people who like doing garden maintenance and are excellent at it, nearly impossible to do it organically. And to get 14 people in a second is worth everything we paid for it. Most of the value in that company that we bought was because we had this team of professionals and recurring revenue. So it was management team is the biggest value. And I mean, the person who sold us the company, she was prepared to keep working, but she really wanted out. She was not prepared for exiting. She didn't build her company to make it more valuable to sell, which made it a little difficult for the transition. And it also meant she left a little bit of money on the table that would have been very valuable for me if we'd had more thorough contracts, multi-year contracts. Those kinds of things added risk to the purchase for me. So I was able to get a little bit of a discount on the value of the company. So, but the management team, every penny was worth it to get that management team. So, like I said, you should know these numbers. You should at least know them once a year when your accountant does your books. You should be making decisions. When you are making a decision on who to hire, making a decision on what type of equipment to buy, whether or not you commit to buying a property or not. How will this affect the long-term value of my business? And to George's point, will it put me out of business if it's the wrong choice? And those are big questions. You don't want to buy a property that's going to bury you in mortgage payments. You can buy a truck that'll be profitable for you because, to George's point, you can sell the truck more easily. It's more of a liquid asset. So make decisions that will make you money, but don't make decisions that'll put you at risk if it goes badly. So it's a balance, but making those right decisions, thinking about long-term value, will benefit you every year as a profitable company, and it will benefit you in 10 or 20 years when you're ready to exit or have to exit if you're forced to exit. Does anyone here know these numbers in their company? Does everyone here look at these at least once a year already? Okay, some of you. It's worth knowing these numbers. It's worth looking at them. Please look at them and just reflect on the decisions you're making. Is it going to help my business or not? That's why we're in business, right? Again, you're not doing this for the charity of your customers. Yes?
Are these numbers that you should have memorized in your head?
You don't need it to the penny. What I'm really looking for is trends. I want to know that your book value is increasing. I want to know that your choices for hire are deepening the bench on your management team. I want to know that your EBITDA, your profit, is getting better next year. The choices I'm making is going to increase my earnings so that it goes into my balance sheet at the end of the year. So do we all agree that we're in business to make more money? Right? We want to make more money. We want to make more money this year. We want to make more money next year. We want to have something at the end of all of this to show for it as well. So, even if that's not your first priority, it is something that's hopefully simmering in the back of your mind, that I love what I do. I just have to make some money doing it. And so these questions and these systems that we're sharing with you today are ways to help you make money so that you can do what you love. So yeah. Case study. So this is where I was just going to share, an example of a company that has earnings, sales, $8 million in sales, earnings of $600,000. So how would you value a company like that, right? There's, book value. You could have $2.5 million in assets in this company, and you could have a management team. If you have 9 good staff, some of them might be worth $5,000, some of them might be worth $20,000, depending on their role. But there's some money in this company, even without understanding what the sales are or profit. You don't even have to have profit in a company like this to have value if it's got book value, if it's got a management team, and if those sales can be plugged into a bigger company that has its own systems and has a profitable system. But this is what the numbers might look like, you know, and it could be that you're doing 800,000 and 60,000, and you know, it could be a tenth of this, which is great. It's where you're at, know where you're at, know where you want to get to, and then through strategic planning, you can map the pathway. And you can start making those choices that you have to make to move you forward on that path. If you don't know where you're going, good chance you're going to get lost. So building a team that can run without you starts with a system. So that's what George talked about. His talk was primarily about organizing your company so that it runs smoothly. And building a team that can run the company without you, which frees you to sell it or exit or become an investor. It starts with a system. A system is information and communication that can be independent from you. It's the right information at the right time with the right people. That is the key to these systems. Bottom line, everything that we've been talking about is making sure the customer has what they need when they need it. The crew has what they need when they need it. You have what you need when you need it. Information and communication is the basis for all of these systems. So we have, you know, meetings. That's what I wanted to share with you. A system that verifies tasks are complete, that verifies that tasks are complete, can be managed. So if your system includes automatic verification, so we get at Oriel, we get our job reports every afternoon. Those come in as part of a process from every crew on every site every day. So the people who need to see that information have it every day. They don't have to search for it. The crew reports, the crew's questions get answered, the office staff's questions get answered, and communication can be forwarded to the client when and as needed as part of a system, and it ensures communication of all stakeholders happens in a timely manner, for example. So this will be too small for those in the back, and it's not critical to read it because I don't even have the whole system here. But what we have is this will expand, these will expand. This is our weekly meeting schedule. And a meeting is an opportunity to share information with the people who need it with an agenda so that exactly what is needed gets shared. No more, no less. Everybody hates meetings that are a waste of time. Everybody hates meetings that could have been an email. So we do as few meetings as needed, and with only the people that are going to value that meeting, but they're pre-scheduled. They happen at the same time. The daily meetings happen at the same time every day. The weekly meetings, same time every week, so that nobody misses a meeting who has to be at the meeting. The crew, they have like a 5 or 10 minute meeting every day to just come up with their game plan for the day. 5 or 10 minutes in the morning. It might be a drag for some people in the morning, but clearing up what is needed, what the objectives are for the day, what the questions are. If somebody needs some help with something, they can share that information, and then they can all be productive at work. They have to, project management, so we have different days. So this is the weekly list. So yeah, we have tailgate meetings, we review metrics. So again, a short meeting with the crew leader, just to say you're on track with this job, or you're behind with this job. Do you need more labor? Do you need more equipment? We look for blockers. It doesn't have to be a long meeting. Sales and receivables meeting, we do that every week. We track all of our customers' journey. So what customers, where are they on our onboarding process? What do they need? Do they have the information they need? We don't want any customer to be left hanging when they're expecting information. We want to make sure that we're constantly communicating with our clients, and we share that information in the office so that we can support each other to give the sales team everything they need. But the meeting doesn't have to be long. I don't think I have an agenda at the meeting in this slide, but every one of these meetings has an agenda. You hit those points in the agenda, it happens regularly, we don't miss anything. That's a system, and that kind of system generates repeatable profit. It creates leaders in our team so that they know what's happening, and our team runs the meetings. So George and I don't run these meetings anymore. Our team can run the meetings because it's easy to follow. The questions are listed in the agenda. They have a discussion. Everybody gets what they need when they need it. And that's really the core of the system: information, communication. Options you can plan for. So some of this succession planning is more predictable. So if your plan is to give it to your kids, that's great. It's something you can work toward. It's something you can train them for. You know, George and I, our kids are not in our business, except Ben is not in landscaping, but Ben is George's son. I'll introduce him a little later. But he's in our consulting business, but it is in your landscaping business. None of our kids wanted to be in the landscaping business. So that might have been a hope of ours 20 years ago. That hope sort of faded away 5 years ago. So it's, but it's not necessary. We didn't build our succession plan on that one outcome. We built a succession plan with multiple possible outcomes. So family was always an option. Staff succession was an option. That was one of the things that we thought was most likely to happen. So we separated the operations company from the holding company. So we separated all of our assets from the operations, partly for liability protection, partly so that if our staff wanted to take over the operations business, they could do it and it would be more affordable, and we could retain the assets and just be landlords basically to the equipment. So that option still stands, but again, it's not necessary for us to do that. It's not necessary for us to sell, and they could be sold together if that happened. Yes.
So when you say that the assets are owned by another company, when did you guys decide to do that? It's like, is it like when you got your 8th machine, or is it like?
Well, it was 2005 where we created a holding company. Yeah, and it's at the same time we created a construction company. So that's when we started Solid Space Construction. We created a holding company, and we had the landscape company for operations. And it diversified where the value was in the different businesses. We segregated the value of the business into multiple companies. So we can still sell it as a group, or we can sell them individually if that is how the outcome came along.
Like incorporated, or is it like a partnership? Like, because it's like for us, like I'm just trying to think like down the road, like for like our company, like at some point you have to make that decision, obviously, right? When we're starting to buy machinery.
Yeah. So we've all of our companies are incorporated, and there's going to be some tax laws that are different for corporations versus partnerships, where the revenue can stay in the corporation, and the corporation pays corporate tax on it. Then the corporation can release it later as dividends. So you can defer some taxes. You can allow things to grow in a lower tax environment while they're growing if it's incorporated. And then again, you have there's some liability protection, and there's also more formal agreements with ownership. Like
so Oriole would hypothetically rent machinery from your holding company, and then like not really money transfer, but there is.
Yeah.
Right,
Yeah. Yep.
And then that's kind of how it runs.
Yes. Yeah, and it's not hypothetical; it's literal. Yeah.
Okay, got it. So account to account.
Yeah. George. I can smell the food. It smells great. So I'm going to punish you a little bit longer. And I'm going to invite Bannis up before lunch to give you a little introduction on what they're working on right now. But I promise it is soon. We will get to lunch very soon. So options with less control or potential risks or rewards, selling to a venture capitalist. This is what's happening a lot in the States, where private equity money is coming in to aggregate blocks of the market. And they're pulling together these things and they're churning them over. There's usually like a 5-year ownership plan with these private equity firms to maximize the value of the company and then resell it. That's not happening as much in Canada right now, but there are acquisitions happening in Canada with some big players. I don't know if you guys know TLC Landscaping in London and Gelderman in Hamilton. They both got bought by Schill Landscaping, which is a great company out of Cleveland that, I don't know, they're doing 130 million or something in sales US, and they're looking at buying blocks. Now they bought a management team and a commercial market, basically. So they instantly got, between 15 and 20 million dollars in sales from each of those purchases. So that is happening in Canada, but not to the same extent as it is in the States. Selling to a competitor. So again, there's some transactions, like the company we bought recently was a direct competitor of ours. So that also happens where you might want to buy a company that's adjacent, like you do landscaping and you want to buy a maintenance company, or you want to buy an irrigation company, because these are things that are a natural progression for your development as a company. So all these options can vary in length of transition, and all options are lower priced if rushed. So this is why the first slide I had was plan early. If you decide that you want to sell your company next year or in 2 years, that's fast, and you're not going to have it prepared so that it's attractive to a seller. You're not going to be able to maximize value in a year to make it worth more money. And you've foregone all of that additional profit from having a good, smooth running operation. So this is why you want to make sure that you plan as far out as possible. Ideally, the minimum I would suggest is 5 years. Like if you're thinking of getting out, 5 years is enough of a runway where we can systemize the business, make it profitable, repeat the profit, and then start looking for buyers. And then the actual transaction takes probably a year. But you have a couple of good years to demonstrate a viable business, you're going to get more money for your company. 5 years is probably the fewest number of years to maximize the operation of your business. Anything more than that, you're pocketing the revenue in the meantime. Anything less than that, you're gonna forego some of that sale value. So be prepared. So asset plan. So it's like I was saying, like what we had. Blake.
If you're a business that's looking to take on shareholders or expand the ownership within your own company, what would that timeline look like, and what are some of the important factors to consider to get started with that?
Yeah, I mean, again, you have to go back to that, the EBITDA and the sales multiples. What is your company worth? What would those shares be worth if you were to sell those shares to an employee or to a outside buyer? And as an employee, you might make it part of their employee package where they get shares as part of the benefits. Like, so if you stay with me for 2 years, you'll get, 10,000 shares or whatever. That could be part of the package, but you better know what your company is worth. And the more your company is worth, the more valuable that benefit is to your employees. But you got to know the number, and they are going to want to know the number. And as soon as you start bringing on additional shareholders, now you have minority shareholder rights. So there's a lot of risk with that too, because what if they leave the company? And if it's a privately held company and they leave, they can't sell the shares on the TSX. And there are legal requirements for you to buy those shares back off of them. And then they're going to get an accountant to put a value on your business. which is different from what your value is. And their value is going to be higher because they want more money for those shares as they walk out the door. So there are some risks. And again, it comes to your long-term plan. What is your ultimate goal? If your ultimate goal is to sell to this person free and clear, and you're going to sell it to them over 5 years, 20% a year for 5 years, that's a contract. And you can agree to what the shares are worth when they're accumulating them. And you can also pre-agree to what they would be worth if the deal falls apart and they exit. That exit price you want to have written down before you start the process, so that you're not in a new legal battle at the end. But yeah, there's schemes for everything.
You need lawyers.
Lawyers and accountants, yeah.
Vestige period, so imagine you're in high.
One more question, Marcello. Yeah, no, that's a good question. Marcello's asking, because he's known us for a long time, and he knows we've had an exit strategy, and we've been talking about it for a long time, and we've been planning for it. We've been making decisions to improve the likelihood of it happening. And what was the process like? The process took longer than we expected. Like, we've had a lot of plans, like, let's do this, let's do that. And, you know, if we think we can get it done in 2 years, it takes 3 years. And a lot of these things. Now, the good news is there was no urgency for us to exit on a particular date. And so we were able to make sure it was right before we took that next step. And it did work. You know, George he doesn't come he comes into the office once a month, maybe, and he doesn't come in to do work. He comes in to, you know, get a cup of coffee, and maybe he's entertaining some of our KTC clients at the Oriole office, giving them a tour. So it worked perfectly. George got exactly what he had been working toward, and for me, I still love doing the work in the office, talking to the staff, but my role now is more as chairman and less as manager or CEO even. I'm a coach in the office, but I still love the client managers do the client work and the design, but I still like talking to them about the design. I like contributing to the design. I like contributing to the sales process. I find that exciting still, but I'm not the lead on any of those jobs. I am their support. My job is to make sure that everybody in the office has what they need when they need it so that they can do all the work.